Hi, this is Randy Finney with Right Side of the Chart, and today's Saturday, August 29th, 2015. And yesterday I did a couple of videos, one being on the US dollar, including a couple other key currencies, the yen and the euro, which really support my case where I think the dollar's headed, and then what impact that will likely have on commodities. So the second part of the video was looking at various commodities such as oil, some of the soft commodities, wheat, corn, etc. And the other video that I did was a look at the recent market action, more from a shorter term to maybe intermediate term perspective. That video, went over the S&P and was focused mainly on the NASDAQ 100, which I've been focusing on personally, more so than the S&P 500. But in this video, what we're going to do here is take a look at the long-term, some trend indicators, long-term trend lines, and a couple other things to really support or take a look at where it's looks like the markets are likely headed, not just in the coming days or really so much in the coming weeks, but in the coming months. We do have quite a few pretty solid sell signals in the market. Some long-term uptrend line and support levels were broken. However, I have a couple of very reliable trend indicators that I follow. I've shared these on the site before, and both of my, or pretty much I should say, all the longer term trend indicators remain bullish at this point in time, although they are only about a bad week or two away from flipping over to bearish. So let's start out here looking at trend lines first. This is the S&P 500. This is a weekly chart, so we're going back, and this includes the entire bull market off the 2009 lows right here. And as you can see, this blue line is our primary bull market uptrend line. This was pointed out, weeks ago. That bull market uptrend line broke. I had this alternative uptrend line, this black one, the black dashed uptrend line, which had quite a few tags. So I did expect a reaction there, and as you can see, if you really zoom in and take a look here, we had a nice reaction off there, a nice bounce on the S&P. Remember, this is a weekly chart going back years, so it may not look like much, but we bounced for a few weeks. And then I stated that, actually back at the time, that we tagged that alternate uptrend line, and that the next sell signal would come on a break below this uptrend line, and that's exactly what happened last week. I should say the week before. We're looking at the red candlestick. So we had a solid breakdown and close, and that in itself is a powerful sell signal. As I've been harping on for not just weeks but months now, these negative divergences foretold of a likely trend reversal in the market. So that's exactly what we had. Okay, now let's take a look at a longer term view. This is the S&P 500, also a weekly chart, but this one spans 20 years. So we're looking at 2 decades, which encompasses 3 very well-defined, clear bull markets and the 2 previous bear markets. And it's again pointed out many times on the site that in each and every one of these instances, the bull market essentially works its way up as a large bearish rising wedge that takes years to form, and each and every one of those bear markets or bull markets were marked at the top with divergence. These we're looking at the RSI up here, the PPO, which works better on longer term time frames than the MACD, but it works in a very similar fashion. So we have those clear divergent highs, and that just shows as 2 things it tells us. Over time, momentum begins to wane, as indicated by these momentum indicators, and prices, the trading ranges tend to contract, and you also have well-defined uptrend lines, which really mark the bull market. So that's our first signal, and again, what happened over the last couple weeks really is a clear and solid breakdown. I often talk about whipsaw signals. Trading the weekly charts, at the very least you want to see a weekly close below these trend lines for the sell signal. We had that back here a few weeks back. As you notice on all of these bull markets, at least at one point, you see these wicks, or these tails I should say, the candlestick shadows down below hanging out. Those are intra-week. Here's another one here, intra-week breaks. And those are not, they're relatively infrequent, but you that's one more reason when trading the weekly charts. If you're a longer term trader or even a typical swing trader and you're looking to put on a short lasting several weeks or months, or exit your longs for that fact, let's say you're bullish and you're riding this bull market up, you don't want to sell your positions or short on an intra-week break. So anyways, with that being said, so you can see in each and every case we had those intra-week breaks. The market managed to print a close back up above that trend line, and now we've had several weeks and we're so far away, and at this point I wouldn't even expect a back test. My guess is we could see several weeks of the market pushing back up, or we could turn around and move lower anytime. But let's go ahead and move on here. This is the OEX, which is the S&P 100. So this is the S&P 500. It's the 500 largest companies. Here's the OX, the top 100 companies. So very comparable, if you will, to the NASDAQ 100 index. And so the charts will look very similar to the S&P 500 we just looked at. But on here, I had made some notations before. If you look down here, the bull market leading into the 2000 highs lasted just under 6 years. It was just shy of 6 years. The previous bull market was 5 months, 5 years, 2 months, 18 days. So 5 years and a quarter, and in the first quarter that after the 5 year mark. Excuse me there. And this one, I did the math the other day, just looking at the highs, assuming those are the highs, which I believe they are, most likely. And so this one took 6.5 years, a little bit longer than the average bull market. But in other words, timing helps play into the fact that the bull market that started in 2009 has most likely seen its best days. And again, the weekly trend line break, at this point, we're so far below, and we've had multiple weekly closes. There's very little chance of recovery, in my opinion. And by recovery, I mean to get back above that trend line in very short order and to go on and take out those the previous highs. Okay, a quick look at the NDX, NASDAQ 100 weekly chart. This is going back several years, encompassing the bear market lows back in 2008, which was actually the bottom for the NDX 100, made a marginal, slightly higher low back in March when the rest of the U.S. markets hit their lows. So you can see clear trend line break, well below it. Divergence in the high, and even along the way we had some very nice corrections, and as I often point out, those are almost always marked by divergent highs as well. Now what I'm doing here, I don't want to beat a dead horse. I know we're looking, okay, got it, we broke down some major trend lines. I think it's critical in trading, at least the way I trade. If I'm looking at the broad markets and trying to call major top or bottom, I want to see all the major indexes, the S&P 500, the NASDAQ 100, the NASDAQ Composite, the mid caps, the small caps. I want to make sure all those indexes have broken down, and that just gives additional confirmation, because sometimes you'll see one index for whatever reason, maybe there's a sector within that index having a vicious bear market, and that index breaks down, but the rest of the U.S. broad markets, if they're still holding support and still in their bull markets or above their bull market uptrend lines, then you may get a false signal. So that's why we're looking at a couple of the major indexes here. Okay, this is the Russell 2000 small cap index. That one actually broke the primary bull market uptrend line back here, all the way must have been back in May, and went up and just did a beautiful back test of it. Beautiful, not if you were short that whole time, but again, that speaks to what I was talking about here. To put on a swing short, saying, okay, the Russell's broken down its bull market uptrend line, while the S&P 500 and NASDAQ had clearly not. That just speaks to what I said looking at the previous chart here, that what it did is the broad markets, in fact, they were rising, just sucked the Russell right up with them. U.S. equities are for the most part going to move together, and especially seeing the small caps break down first without large caps. Large caps have a bigger importance, if you will, on the market and the economy and everything else. So what happened is they did back tests. It's a beautiful case of technical analysis, and I pointed out this parallel trend line underneath, so it's sort of formed a channel, slightly contracting. Really, you can draw a wedge here, which I had, and all these annotations have been on this chart for weeks. Even this purple arrow, when we were back up here, I pointed out the sub-uptrend line, that's this line here, slash wedge breakdown, and drew this purple arrow, and you can see, you know, that was my expectation, and we moved down there. These Fibonacci fan lines I've talked about in the past are just incredible, the way that the Russell has traded off those, and I've stated for many months now that that would be my next downside target, and you can see that we came within just a hair of that, and I could probably move them and tweak them, and it might show that we actually hit that. So this is one thing throughout this video, at least in the end when I wrap it up, I'll say I do have some concerns about how quickly it will take for the market to head lower. In other words, for the next major leg down, and that is because I have quite a few either key stocks or some major indexes or sectors hitting the downside targets that I've had and discussed on the site for a while. So in one aspect, in other words, I often talk about how I expect a reaction off an initial tag of support. So I don't think these fib fan lines will hold forever, but with the Russell and some other key stocks or sectors hitting some of my downside targets, including the NASDAQ 100, we could be looking at a bounce here that lasts for a few weeks, possibly a few months or more. It's really hard to say, and again, this is the longer term picture, just trying to see where we're at. And if the chances are that we have begun a new bear market, because if so, that's where you want to start adapting your trading style, where you look more to short the rips than you look to buy the dips. This is the S&P 400 mid-cap index, so we just looked at the small caps. We've already looked at the large caps, and this is the mid-caps, which are a very important, subsector of the, U.S. equity markets. Beautiful chart. I mean, you just look at the trend line. We had a back test. Prices, again, this speaks to what I just said about the large caps not breaking down earlier. The small and the mid caps broke down earlier this year, but with the broad markets, or the broad averages, S&P 500, Wilshire, all moving higher, it brought the small and mid caps up, and they made a new high. They managed to eke out a new high. Divergences confirmed on those new highs, and this is why, in my book, although at face value a lot of traders may have viewed that as a bullish technical event, of course, anytime stock or market makes new highs, sure, on face value, but when you have that new high only extending powerful bearish divergences that were already in place, I pointed out in the past, if you look at the black vertical lines here, those are cycle lines, and these lines are exactly 199 days apart, and that marked the previous high of the high of the bear market back here in 07. We had this high with a bear market. Most people you don't hear on TV very often. We've experienced bear markets in the Russell 2000, in the NASDAQ composite, and here in the mid caps. That all happened back in 2011. So the S&P didn't manage to take out the 20% level. That's what technically defines a bear market: a drop of 20% or more. Drop of 10% or more is a correction. So, these had a bear market, and so these cycle lines were relevant. They marked that high, and you can see it wasn't very far. We just passed the 199-day mark by a little bit here, with really for the most part, the mid-caps going nowhere from that point. It just really traded sideways, made a slightly higher high, and then rolled over. So this, again, speaks to the case that the mid-caps are most likely in a bear market, with more downside to come. Okay, and this is the last one to talk about trend lines. So this is the Wilshire 5000 composite index. Of all the stock indices out there, this would be the most representative by far, with nearly 5,000, roughly 5,000 components. It is pretty much an all-encompassing stock index. So as you can see here, again, just like the S&P 500 charts, the NASDAQ, here you have these rising wedges, bull markets, and when you get those uptrend line breaks, in the past, that has been, officially, if you want to say, the kickoff of a bear market. And we're, like I said, clearly below that, multiple weeks. So very unlikely you're going to see the market at this point going to make new highs. But now let's look at the trend indicators, because that will be our all-in, confirmation where, I can say as definitively as you can ever possibly say. There's what I mean by that is nothing is 100% certain in the markets, but when my trend indicators confirm, that's when I think it's safe to say that we're looking at considerable downside to come in the following months. Okay, this first chart I've mentioned many times over the years. It looks crazy with all these lines. I took the time recently to really mark every buy and sell signal. You can pause the video, take a look at this. There's also a static post of this chart not so long ago on the site. You can use the search function there, or the post by ticker, and pull up SPX and take a look. But what this shows is, yes, there have been quite a few whipsaws. When you see lines close together like that, those are whipsaw signals. And I should clarify, this is the daily, an S&P 500 daily chart using a 20 and 50 EMA pair, the exponential moving averages. And as you can see, and as I pointed out here, although far from a perfect indicator, it has done an excellent job of getting you in early, relatively early, on all the major trends in the market. In other words, start here on the left margin. You could see when we were in a bear market back in the, off the 2000 highs, it kept you short. Red is sell, get out, or short. Green is buy, okay, to get back in. So you had a little whipsaw. But again, if you really freeze this chart and look at it, the whipsaws didn't really get you, you're on the wrong side of the trade for a little bit, but the moves were relatively minor, especially compared to getting back in and catching the bulk of the trends. The whipsaws are going to come because the market does have these sideways consolidation periods from time to time. But as you can see here, when you see the space between, these are the major rips and trends, I should say, within each market. Here's a bear market in 08. From actually topped in October 2007, but you can see that this indicator would have kept you short most of the time on the big trends and got you in long when you needed to be. And this huge, almost unprecedented move up, in the last couple of years, you caught the bulk of it long. And my point is that we are solidly, this histogram, all this does down below is just show you a differential between the two moving averages. In other words, when it's green, the 20 is above the 50-day, and the higher the green bars, the more space there is between. So it gives me a heads up on crossovers. Whenever I see this move down to the orange, cross from green to orange, that means that pair is crossed over. So that's the daily trend. And as I said, even with the tremendous snapback rally we had this week, to recoup all of Monday's losses, we're still solidly on a sell signal on this intermediate term trend indicator. Now, this is where it gets really good. For those of you who said, well, yeah, that's crazy, in, out, in, out, in, out. Again, use that to help, especially a more active trader. That 2050 would really help you keep your trades on the right side of the trend. But the weekly and monthly indicators I have are just, to me, very simple and highly effective. As you can see here, what we have is a weekly chart. This is a 20-year time span. So we're looking at 2 decades using a 17 and a 43-week EMA, exponential moving average. The red dotted lines show the bearish crossovers. Again, I did the same thing down here by just replicating the moving average pair into a histogram here. So when it crosses down, so these lines, in other words, where you see a red, that will be this moving from green to, well, I guess this brownish color. I could have put that as red. And you talk about catching a trend. This is it. So if you're an investor, 401k money, IRAs, long-term stuff, and you're not really much of an active trader, this is the chart for you, as well as the monthly trends. And as you can see, it caught the vast majority of each and every bull and bear trend, bull and bear market. And what I have here, these are black lines with a dash and two dots. That's a whipsaw signal. So within 20 years, you had one whipsaw signal. And as I said, if you look down here, the chart on the bottom is the S&P 500, and you can see that even had you been caught up in that whipsaw signal, you would have had a little loss because it told you to sell here back in it looks like about the end of the third quarter or so in 2011, and right around the beginning of 2012 it told you to get back long, and so that would have been your one loss. So again, right now, most importantly, what I'm looking at, you can see the 17-week EMA is coming down very strong, as it has every time you look at these the bull market tops. You can see the 17 turn down, so it is pointed lower. And another thing to note, look at the slope, if you will. If you really zoom in on this, the 43-week EMA, that is now pointed lower. In other words, the slope is negative. That can and will turn up if the market bounces, moves higher in the next few weeks. That'll turn up, and so will the posture, at least the red line, possibly the 17-week EMA. But as of now, they're headed lower. You can see it from the histogram and the levels. So we're about one bad week, no more than 2 bad weeks away, assuming we don't have a lot of positive weeks in the next few weeks, up weeks in the market, that is. We are just a couple weeks away from getting a sell signal on here, and that would only help to confirm everything I just talked about on those trend line breaks, but we're not there yet. So to load up on shorts or to sell all your longs and walk away right now, it just doesn't make sense, because we only have to wait maybe a few weeks, maybe a few months, maybe these reverse. Sometimes these moving averages turn, the market can go up, and we don't get that signal. So to be long-term, establishing long-term short positions here and selling the last year longs if you're an investor is a little premature, when all you have to do is just give it a little time and see what happens here. Okay, this is my monthly trend indicator. This uses a 10 and a 6 EMA, so that's a monthly exponential moving averages, because we're looking at a 20-year history monthly chart here. So you can see, similar to the weekly indicator, it's a little more foolproof. We did have a whipsaw. We didn't go as deep into territory, so it's going to work very similar. Those are both my longer-term trend indicators, like I said, the weekly and the monthly, and they just help to define, or I should say, confirm the trend. And like I said, they get you in pretty early at the tops, short that is, and they get you long, not too far off the bottoms. So we're close. You can see very close. Again, just this is a monthly indicator. So what you have to do is wait for a monthly close. So right now we only have, basically we're not going to make it here. Doubtful we're going to see a month-end close. Doubtful but possible, because Monday will be the last trading day of the month. So if we had another huge down day on Monday, we might get these, and then that would be additional confirmation to the recent breakdowns that we saw from the trend line. Okay, so I've explained how those trend indicators work, and we'll just look at a couple other indexes. Here's the NDX, the NASDAQ 100. This is on the weekly, the same 1743 weekly. And you can see here that one, because the NASDAQ is a more volatile index, you have a couple more whipsaw signals. This one here was so brief, it only lasted about a week. So you can't probably even make it out on this chart unless you're looking at the YouTube video on a big screen. Again, replicate this on your own chart. There was a slight brief crossover. It lasted about a week or so there. So a minimal whipsaw signal would have got you in, right back out. And then another whipsaw signal here. Other than that, it's done a pretty good job. This line should be green here. I don't know, somehow I accidentally colored it gray, but you can see it would have gotten you long back in not long after the bottom of the market bottom. You can see it down here, and kept you long since. And the NASDAQ still has a way to go. I've mentioned recently in recent weeks that the NASDAQ, in my opinion, and that's why I'm trading it, I think has the most downside of all the major diversified indexes, more so than the S&P 500. And so I think, if I'm right here and in the coming months we see the market continue to move lower, I think you're going to get more bang for your buck being short the NASDAQ than the S&P 500. And this is the NASDAQ with that monthly 610 EMA pair trend. Only one whipsaw signal, a very brief whipsaw signal back in mid-2006. Other than that, it has done a perfect job of defining the bull and bear trend. So, as I said, we still have a little work to do there, so that one's not confirming a bear market yet in the NASDAQ 100. Here's the Wilshire 5000, as I mentioned, a more representative index than the S&P or the NASDAQ 100, and because it includes more components, more sectors, more market cap weighted stocks, and you can see that one is just poised with the 17 EMA moving down very sharply and poised on any additional downside here in the market to make a bearish crossover. So you can see from the histogram there, rolling down quickly. Again, we're not there yet, but we could be within the next few weeks if we do see the market even just trade sideways from here. That would most likely, that's going to bring the EMA pairs down as well. Okay, and that's it. I won't go over each and every index on the trend indicators, but they're all saying pretty much the same thing. We're very close there to triggering. All the long-term uptrend lines are broken. The key moving averages, most of those are broken. And my concern here on what happens next is that we did hit quite a few of my price targets on some of the key stocks that I shorted recently. Those were short trades on the site. Here we're looking at the NASDAQ 100, a daily chart. I've had these targets up for many months, if not the entire year, and I usually date these, but I've had these annotations up here, the notes that my final target T3 would be the first of the dash primary black uptrend line, this dashed uptrend line here, or this 3470 to 3700 level, and we hit that. We almost hammered right off that trend line. I mean, that opening gap that morning was lower, and we rallied all the way back up. So looking at this, now it's hard to make out on the chart because I had the red here because I had forecasted this would be where the drop would occur, just like these other corrections here. And I had T1, T2, T3. So really within just 1 week, we went down, hit my second target there. That was, I believe, on last Friday's close, not yesterday, the Friday before. And then we had that boom, big down on Monday. So there's a concern is that I have a lot, not just the NASDAQ 100, but some other sectors such as Biotech. When you look at IBB, I'll look at that in a second, hitting targets. And as I often state on the site, a reaction, especially off a final target level I have, and a reaction on the initial tag is highly likely. In fact, I came out on Monday and said that and pointed that out, that I expected more upside. And here's my notes actually posted on Monday. My final near-term target was hit, and even if we are headed lower in the coming months, the odds for a bounce off this initial tag of support is very likely. So we got that initial bounce. And what's nice about it is you look where the bounce is, you can see the price here, 43.29.12. That's just closed right back under this blue uptrend line. So we closed to back test that recently broken blue uptrend line. And, I continue to think that even if we do push higher, there's just a mountain of resistance overhead. So, I'm personally started scaling back in short the last couple days. I don't see a lot of risk being short, not a lot of risk to the upside here. And I do think there is a possibility that because these targets were hit so fast, the opening, that candlestick, if you look at Monday's price action, the market's gap down. There was a lot of order imbalances, and everything went crazy. There were many crashes in many securities and ETFs, including the QQQ. And my point being is that almost any point in time when the market moves down to hit a support level or rise up to hit a resistance level or a price target, the whole market's moving, and the way technical analysis works, that is the whole mass of buyers and sellers in the marketplace at that time interacting. In other words, you come down, hit a support level, it clear out the last of the weak-handed longs because this market's been moving down, and you have a new wave of buyers that step in. I don't think that happened Monday morning, at least not to the full extent, because what happened, that opening gap when this little level was hit, happened so fast that within seconds the market moved back up. Those order imbalances were closed. So I don't think that was a true washout. I don't think a lot of people had time to react. And I know that the average Joe who was, sitting in their office working and probably didn't hear about that until somebody texted them that the market was down, or they got home and watched the evening news, so they didn't have time to react, and at that point the market shot back. So again, those are just thoughts bouncing in my head, and why I don't want to say I completely dismiss the fact that these targets were hit, but I dismiss that they might have long-term implications. So I think we had that technical bounce, and still leaning towards another thrust lower that will be could be pretty fast and swift. So we'll see. All right, this video has gone a little longer than I wanted, so I won't go over anything but the biotechs. I've stated, put a video out recently expecting a bear market in the biotechs, and that's another thing. We got that bear market. We hit the targets. When I went over that IBB, this was a key weekly support, and we almost hit that. We came very close to that in IBB, this 278 horizontal line, bounced back up, and you can see here hit this blue trend line, which is the uptrend line that I've been focusing on. We took that out, but we managed to close back above it, and that gives me a little bit of pause. However, we have the 40-week exponential moving average, the red line. You can see how well it has defined this uptrend since the biotechs really took off. I mean, this is when technically their bull market started. It was a kind of a gradual climb, but from this point on, that's where the uptrend line goes, and that's where this 40-week moving average did well. So we're back testing that 40-week. We got up above the trend line by a little bit. Now, if we manage to hold it if we don't reverse next week and get back below that trend line, I will begin to question the shorts that I put back on. As I posted, I took profits on the crash on Monday morning on my LABU short and some other biotechs that I had, and I've recently just added them back on here. So again, a lot of supports hit, a couple of stick saves. By stick save, I mean this candlestick, weekly candlestick, managed to close back up above a key support level. So that's one thing there. The other is when I look at the biotechs, this gives me a little bit more confidence that they still have a lot more to go. We had that huge drop in PBE, which is another one of the big biotech ETFs. This one clearly did not manage to get back above. They had a very well-defined, beautiful bearish rising wedge pattern, again, talked about in the video. Had a huge drop. This was one with the mini crash. In other words, this ETF went down a lot more than the individual components. I took a look at their charts, so it's just a case of this is what happened, and this is why I say this. The charts are somewhat skewed from what happened Monday morning, at least in a lot of sectors, and even the QQQ, which dropped a lot more than the NASDAQ 100. And as you can see here, there's that 40-week EMA. So we hammered, which is, may appear bullish, but the bottom line is we close right back up against that 40-week EMA, and even if we push a little higher, all that will do is serve to backtest this large wedge, and I think we're going to get another thrust down. In other words, I don't think it'd be very rare and unique to see, because this was a bear market. You measure from the highs to the lows. If you want to on PBE, that's a 46% drop. Yeah, about a 46% drop, and it happened just a couple weeks. So time-wise, it just doesn't feel right that this market's just going to trade, in fast-forward speed going forward. I think that's the shot across the bow, and there'll be more to come. So, anyways, I hope you enjoyed the video. This has been Randy Finney with Right Side of the Chart.